Now we are going to discuss about the Silicon Valley Bank collapse. In March 2003, a bank that had survived for 40 years, banked off all US venture backed startups and held over $200 billion in asset, collapsed in roughly 48 hours. Exactly that 48 hours. Not because of mistake, not because of fraud. It collapsed largely because of something we have actually already talked about in this series. Interest rate risk and a failure of hedge it properly. So first, what made SVB different? To understand the collapse, you need to understand SVB's usually position. SVB was the go-to bank for startup and venture capital. During the 2020 and 2021, startup raised enormous amounts of cash, and much of it sat in deposit at SVB. The bank's deposit roughly doubled in a short period, swelling with the cash that had nowhere else to go yet. Banks don't just let deposits sit idle. They invest much of it to earn a return. SVB took a large portion of this flood of deposits and investment heavily in long-term US government bond and mortgage-backed securities, which paid steadily, safe-seeming returns. The hidden risk, long-term bonds and rising rates. Here, where the real problem began, and it connects directly to something fundamental about bonds. When interest rate rise, the market value of existing lower rate bonds falls. While if you're holding a bond paying 1.5 and new bond suddenly pay 4.5 percentage, nobody wants your old bond at full price anymore. It market value has to drop to compete. Starting in 2022, the US Federal Reserve raised interest rates aggressively and rapidly to fight inflation. SVB massive pile of long-term bonds brought back when rates were low, lost a substantial amount of market value among overnight. On paper, SVB had classified many of these bonds as held to maturity, meaning on their accounting book, they didn't have to immediately show the loss as long as they intend to hold the bond until they mature, but the real economical loss exists either way. It just it just was not fully visible on the surface yet. The missing hedge. Remember our earlier videos on hedging and the interest rate swaps? This is exactly the kind of risk those tools exist to manage. The bank sitting on a large pile of long-term fixed rate bonds, worried about rising rates, could use interest rate swap or other hedges to offset that risk. Much like the interest rate swap, example from our earlier videos, where one party trade fixed rate exposed for floating. Reports following that collapsed indicated SVB had significantly scaled back its interest rate hedging in the period leading up to the crisis, leaving the bank far more exposed to rising rates that it needed to be, whether by choosing bad judgments or underappreciating the risk. The protection that could have substantial cushioned this exact scenario largely was not there when it matters. The shock, a concentrated jittery depository base. Here, the final ingredient that turned a balance sheet problem into a 48 hours collapse. SVB depositors were unusually concentrated and unusually connected. Most of the SVB deposit came from startups and venture capital firms, a tightly networked community that communicates constantly, including on group chats and social media. Many of these deposits also exceeds the 22 lakh $50,000 FDIC insurance limit, meaning a meaningful chunk of money at SVB was not guaranteed safe if the bank failed. When if SVB announced it needed to raise capital to shore up its balance sheet, essentially confirming the bond losses were a real problem. Words spread through these tightly connected communities almost instantly. Prominent venture capital firms began advertising portfolio companies to pull their money out, and the depositories tried to withdraw a report of 42 billion dollars in a single day. No bank, no matter how healthy, can survey that kind of withdrawal speed. This is what someone called a modern social media accelerate bank run. The fall and the aftermath. Regulators shut down Silicon Valley Bank on March 10th, 2023, make it one of the largest bank failures in US history. What happened next? US regulators took the unusual step of guaranteeing all deposit at SVB, including amounts above the normal 2 lakh $50,000 insurable limit to prevent panic from spreading to other banks. A similar feeling panic hit other regional banks in the following days, including Signature Bank, which also failed shortly of its business. The episode sparked renewed regulatory scrutiny of how banks managed interest rate risk, how they hedge it, and how they deposit. Concentration and social media can accelerate a bank run far faster than in the past. So, quick recap. SVB invested a flood of startup deposit into a long-term bonds. Rapid interest rate hikes were rapid interest rate hikely reduced the market value of those bonds. SVB had scaled back the very hedge designed to protect against those risks. A concentrated, socially connected depositors based panicked and withdraw 10 of billion in a day. Regulatory stepped in, but SVB still became one of the largest bank failures in the US history. The core lesson is interest rate risk is not an abstract textbook concept. It is exactly the kind of risk hedging tools exist to manage, and going without the protection can turn a slow moving balance sheet problem into a overnight collapse.